Welcome back to EDS, and in this video I'm going to show you the fastest way to grow your account consistently without going into large drawdowns and without taking unnecessary risks. So what we're going to be doing is we're going to be utilizing options contracts and futures contracts. So specifically we are going to be writing options contracts on futures contracts, and the reason why we do this is because when we write options contracts, we can do so giving us a high probability of success, which is going to give us nice and consistent returns. And we use futures because futures uses span margin, and span margin is very capital efficient, and it's perfect for all size accounts, especially if you have a smaller account. So what we want to do is pull up a list of futures contracts that have options available to trade on them, and that's what we can see here. I personally like to order everything from high to low IV rank, and you want to pick something that has an IV rank of at least 30. You can go all the way up to, for example, the Canadian dollar futures with an IV rank of 110. I generally personally like to be anywhere in the mid to high range, so we're just going to go with NG. NG looks quite nice. The British pound futures could also be quite nice. In fact, let's go with the British pound futures. We recently had a position on it, but we took it off because we hit our take profit. So let's just go back to the British pound futures here. It's trading at a little over 1.21. It has an IV rank of 62.5 and an absolute IV level of 11.7%. So now what you want to do is go over to where you can see a list of expiration dates for the underlying. Now there's two things that you need to keep in mind here. You've got the actual futures contracts expiration dates, then you have the options contracts expiration dates. If you're using a good broker, then it should be integrated pretty easily all in one. So if you have a look here, February, March, these are your option contract expiration dates. But if you have a look here, we've got February, March, which is on the same futures contract, 6BH5, and then April, May, it goes over to 6BM5. So as long as you're using a good broker, this will be automatically done for you. You won't really need to worry about the futures expiration dates. You just want to concentrate more on the options expiration dates. So the one that we want to pick needs to be around between 30 and 60 days out. And you don't really need to worry about weekly or quarterlies for futures too much. But if it is available, just stick with a monthly. All of these expiration dates here are monthlies. If it was a weekly or quarterly, it would be displayed. So we're going to go with March 7th, which is 53 days out in time. So we're just going to open that up, and here we can see the options chain for the 6BH5 futures contract. Now what we want to do is we want to sell one call and one put. Very simple, but we need to, let me explain to you what it is that we're looking at. So this orange horizontal line shows us where the price of the British pound futures is with respect to the strikes, and of course the numbers here in the middle are our strikes, and this vertical orange bar shows us what the expected move is of the British pound futures over the next 53 days. These dotted blue lines show us our standard deviation levels. We have our bid and ask on either side for calls and puts. We have our delta as well on either side for calls and puts. So what we're going to do is we've selected a futures contract to trade, which is going to allow us to use span margin, which is going to allow us to be very capital efficient, which is going to allow us to get a very nice return on capital. Now we want to make sure that we are getting high probabilities of success. So we're going to use the expected move, we're going to use the standard deviation levels, and we're going to use delta. So we're going to use all three things to ensure we get a high probability of success. So when we are writing options contracts, what that means is we want price to stay away from that contract. So if we were to write a contract at, say, the 1.2 strike here, price is currently at 1.2167, so we would want price to stay away from 1.2. We wouldn't want price to go below 1.2. Otherwise, that could be a problem for us. So we're going to use the expected move, and we're going to write contracts that land outside of this expected move. Okay. The further outside this expected move you go, the higher your probabilities of success will be. But the further out you go, the less premium you collect. So we want to be outside of the expected move, and we're going to use standard deviations next. So we want to be in and around the 1 standard deviation level. And just to tie everything up, anything between a 15 and 20 delta will do. So if you come over to the delta column, we've got a 15 delta here on the call side at 1.265, the 1.265 strike. And if you notice, we're sitting just on the edge of the 1 standard deviation level. And we're going to do the same thing on the put side. We've got a 15 delta here at the 1.16 strike. And again, we are just on the edge, the other side of the 1 standard deviation level this time. However, it doesn't matter. A couple of strikes here and there, it doesn't make too much of a difference. But the important thing is we've got 15 delta on either side. We're in and around the 1 standard deviation level, and we are outside the expected move. Now, how high of a probability of success does this give us? Well, if we look in the bottom left corner, we've got a pop here. Pop means probability of profit, and that is your probability of making at least a penny on this position, and that is sitting at 74% right now. Now, normally for equities, we would have our P50 displayed here as well. However, for futures, it doesn't display that. But generally speaking, our P50 is about 10 to 15% higher than our pop, and our P50 is simply just your probability of making or getting to 50% of max profit on this position. So we'd be looking at probabilities of success between 74 and 90% on this position, which already, without doing too much work, is excellent, right? We've got probabilities of success of between 74 and 90%, which is extremely high. We've got a very clean and simple position here, just 2 contracts, and this number down here at the bottom is the price that we would, the mid price basically, and this is what we would want to try and get filled at. Now, this is in dollars, so this is $0.0081. Now you might be thinking that's not a lot of money, and you're right, it isn't a lot of money. However, for futures, so for equities, you have a contract multiplier of 100. So every contract controls 100 shares. For futures, it varies, and for currencies, for the British pound futures, off the top of my head, I don't know exactly what the multiplier is. However, it's in the hundreds of thousands. It's over 100,000. So you would multiply this out by the contract multiplier, but fortunately, we don't need to do that. The broker does it automatically, and we get to our max profit here. So although this number looks small, we would actually collect $506.25. After you multiply it out by the contract multiplier, it works out to $506.25. We would collect that on entry on this position, and this would get added to our cash balance. So our broker is now going to require us some buying power in order to hold some capital and buying power in order to open this position. And that's going to be $857.08. So our broker is going to hold $857, and we're going to collect $506, and we've got between 74 and 90% probability of success. As you can see here, we've accomplished what we set out to do: high probability of success, high return on capital. Now the only other thing is the size of this position. Now $857 should be fine to fit inside almost every portfolio. However, if you've got a really small account, I'm going to show you what to do to reduce this number here. Okay, now one thing that you could do is you could simply reduce your deltas. You could go all the way out on your deltas. Now what you'll notice is you collect much less premium. Your max profit is now 162. Your buying power requirement does drop, and your pop significantly increases. Now, I personally don't like to do this. However, you can do it, and it's perfectly fine. It's perfectly viable. What I would personally prefer to do is actually do the opposite, be more aggressive. Say we go to the 21 delta on either side here. Now we're going to collect $756 in premium. Our buying power requirement has increased now, and our probabilities of success have reduced slightly. Now you're probably wondering, this is the opposite of what we need to do. But what we're going to do is we're going to use some of this premium here to buy some long contracts to cover our shorts. So we're going to go, say, 0.005 further out of the money, say to the next strike down, which is 1.26, and we simply buy that contract, right? Our premium has reduced because we've used some of the premium to buy this contract. And we're going to do the same thing on the put side. We're going to go one strike down, which is 0.005 away. You want to keep the spread the same on either side, and we're going to buy that contract. So what we've done now is we've created a spread on either side. Okay. Now, if you take a look at our return here, we will collect $118.75, but our buying power requirement is now $98. So we've now got an even higher return on capital. Our max loss here is $193, but we don't need to worry about that in most cases. We've got a pop of 57, and our P50 will most likely be sitting in and around 70-75%. So this is personally what I would prefer to do if you really needed to reduce your buying power requirement. If you are able to have a slightly larger position, you can simply just widen out your spread a little bit. You'll collect more premium up front. It will require slightly more buying power, but you can just play with it depending on the size of your account. And this is how you can find and manipulate positions. This is how you get a high probability of success, a high win rate, a high return on capital. And you can do this in a large account, small account, it doesn't matter. It's just such a powerful thing that everybody can do. Everybody should be doing this. Everybody in the whole world should be doing this, in my opinion. And so the only thing left is to figure out how much buying power should you be allocating to your positions. Well, in order to figure that out, we've created a free position sizing template. The link is in the description. Just click on that button and it will take you to this spreadsheet. And the way it works is you enter in the size of your portfolio. So let's say if it's $10,000, you then enter in whatever the current VIX level is, say if it's 32.6, and then everything below will be automatically calculated for you. All you need to do is use this information to form the backbone of your portfolio. It will tell you the maximum amount of buying power to allocate to any single defined risk position, undefined risk position, how much of your portfolio you should be allocating to short premium strategies in general. And as long as you're following this, you'll be absolutely fine over the long run. If you want to learn in more detail about what we do and how we do it, again, link will be in the description. This time click on EDS Premium. Get yourself signed up. Inside you'll have access to our portfolios that will allow you to see the positions that we're placing, how we're managing risk, how we're making adjustments, all in real time. And there's also a full course. So no prior knowledge is required. We will teach you everything that you need to know from start to finish. And if you get stuck, it is a private community, so you can speak with myself directly or with other like-minded individuals. There's also a 100% money-back guarantee. So once you have studied the full course and followed our trades for at least 6 months, if at that point you are not profitable, then we will work with you for free until you are. Or you can simply request a full refund. So it's completely risk-free. It's £1 a month to join. It's so cheap because we've just launched. The price will be increasing. However, once you're in, the price is locked in for you for life. So you are definitely rewarded for getting in early. And the aim of EDS Premium is to teach you how to write options contracts, to teach you how to consistently grow your portfolio. And the aim is to give you the skill. We don't want to keep you reliant on us. We want to give you the skill, so it's something that no one can take away from you. It's something that you can do for the rest of your life over and over and over again. And we aim to get you to that point where you've learned the skill and you don't need any external help or influence in 6 to 12 months. You are always welcome to stay and be a part of the community. However, within 6 to 12 months, you should be good to go. So with that being said, I will see you guys on the inside.